to this episode of The Money Movement here in early 2022. I'm really pleased to be joined today by Sid Powell, who's a co-founder of Maple Finance. We're going to get into a lot of detail about what Maple Finance is. I've been tracking the work that Sid and team have been doing for quite a while now, for the last, I don't know if it's been a year. I think you guys launched last spring, maybe summer.
Yeah, it was around May.
Yeah, exactly. Yeah, so have been watching this, and I think Maple is a fascinating project that is, I think, representing a kind of taking institutional markets models in debt, in lending, and kind of re-envisioning it and rebuilding it entirely on chain. And here at Circle, we see a lot of really interesting use cases with USDC and in DeFi. And I think there's this kind of fusion of TradFi, DeFi, stablecoins, and I think in some ways maybe we're seeing the birth of the future of global debt markets kind of happening here. So a lot to talk about on all those themes, but maybe just to get started, Sid, tell us a little bit about your own journey, your background, and kind of how you got into crypto, as people always like to ask and share, and then we'll drill in from there.
Yeah, sure. And very happy to be here. Thanks, Jeremy. So I came from a debt capital markets background, and this was working in institutional banking back in Australia, where I was involved in securitization. And so what that means was largely we were helping lending companies to access funding from banks and from investors so that they could grow their business and lend more money to customers. So I was doing that for a while, but I was always more interested in kind of working with the entrepreneurial builders who were our clients. And then I eventually had the opportunity to go across and actually join a commercial lending fintech and to help them raise capital so that they could grow their own business. And it was being on the client side and actually having to go through the process of working with banks, working with investors to try and borrow and access debt capital markets as a customer to support our growth that, I became very conscious of the process hasn't really changed in about 30 years. You deal with a lot of lawyers, you deal with a lot of different third parties, and it's actually very slow for innovative companies to actually access the funding they need to grow. And so this was around about early to mid 2018. We started learning about smart contracts, and that was actually where I met my co-founder. And we started learning about this idea that, well, maybe you could actually have programmatic bonds or you could have programmatic loans. And that really hit a nerve for us. Well, we started to think, well, we've got hundreds of pages of legal documents that all just say if this, then that. And couldn't that be done way more efficiently with code? And then couldn't you set up some kind of infrastructure that would actually link the companies around the world to a marketplace for these products? And so anyway, we kind of ground away for about 18 months, writing white papers, trying to come up with a proof of concept. And then it was really late last year that we were actually able to raise funding and to start to build out the team. And what that coincided with was broader acceptance of DeFi. I remember when we first started, people were saying, no, DeFi yields will not be a thing. Therefore, you can't really build some kind of credit marketplace. And so that's what we set about to build, which is a marketplace for growth capital built on top of Web3 technology that innovative companies from around the world can access, really to fund this kind of next disruptive era in history.
It's awesome, and I think the idea of programmable money, it's been something that a lot of people have talked about for a long time. We're obviously seeing it play out in a big way with smart contracts now, and there's a glimmer in people's eyes. I remember, when we founded Circle in 2013, like this was like the thing that got me really excited. And actually, in the early days in our original Series A presentation, it was like, you're going to be able to have programmable smart contracts, and we envisioned like stable coins, like, you know, what we thought they weren't possible then, but we were thinking about it, and specifically the idea that entrepreneurs or people who create value, who want to securitize their value creation in some form and efficiently put that into an internet capital market with the frictionless, you know, ness of the equivalent of like setting up a shop on Alibaba or on Amazon, like that was inspiring. It was like, okay, that's going to become possible. And you know, I think, you know, I remember we'd have board meetings and, you know, we'd talk about the phases of sort of how this would go. And, you know, and I always thought like that kind of stuff would be like in the 10 to 20 year timeframe. That was 2013. But you know, we're now, you know, 8.5 years and it's here. I mean, these building blocks are here. And so it's a really, really exciting moment. And I know, you know, a lot of this stuff still feels really nascent and like the user experience for all these things, but it is really getting started. So with Maple specifically, maybe walk through, you know, the kind of architecture of how different types of entities might interact with it. And then maybe, I mean, just at a high level, just the sort of tech stack today and how you think about that as well.
Yeah, so at a very high level, how Maple works is it's obviously, it's a lending marketplace. So on either side of that, you have the borrowers. And our borrowers today are primarily crypto native companies, and they're choosing to use us because they might be very profitable, but they struggle to access capital from banks. And that's because the space still largely has a bit of a reputational risk around it for traditional lenders, where they kind of view it as akin to alcohol, firearms, and tobacco, for lack of a better analogy. So that's one side of the marketplace, and they're borrowing from on-chain pools. And the way I think about pools is that they really provide the infrastructure for this kind of on-chain lending business. So you can think of a pool similar to like a debt fund or an OTC lending desk. And what's different about Maple is that each pool has a manager, and this is a sophisticated underwriter. Often it's a fund manager or an asset manager or a team with, you know, with fixed income or banking experience. And what they're doing is they're talking to the borrowers, assessing the nature of their business, and then vetting that they can repay the loans. And then they approve these loans to go out on-chain from that pool. And then the funding for the pool has come from the lenders. So you've got three parties on our systems. You've got the borrower, the delegate who's managing a pool, and then you've got the lenders. And the lenders are largely institutions who want to get a yield on their stablecoins. So that's a perfect use case for USDC, and other component is, of course, how we manage risk on the platform, and that's done through staking, staking a reserve to the
right. So and there's lots to break down there, but no, it's fascinating. So I mean, I think a lot of people who are familiar with DeFi, think about it as, okay, here's a way that traders do margin borrowing to do more trading, right? And there are obviously exceptions to that. A lot of this over collateralized crypto collateral borrowing to do things. That's one very large, use case. There are certainly people who are, kind of margin borrowing to buy a car or a house or whatever. Retail level stuff. But I think the idea of a debt market where there's a marketplace and where you're organizing, a market structure, which has actually got some similarities to existing debt market structures. So you're creating a debt market structure, and this idea of, when people think of pools, liquidity pools, yes, people know that anyone can come in and be an LP in a DeFi protocol, but here in Maple, it's really different. Like a pool manager, I guess you call it pool delegate or what have you, is really a professional debt investor and underwriter, right? So you're creating confidence on top of this. You happen to be organizing all of it on chain, right? So it's everything is, transparent and on chain. The actual, funds, if there's going to be collateral, everything's on chain, right? So unlike with the legacy financial system, which is just like a bunch of paper docs fly over a wall and then the wire goes, okay, what's going on? This is just, more auditable, more transparent, more secure in many respects. But that kind of creating that intermediary of a professional manager, in a sense, is like a really significant difference between the way you're building these lending markets compared to general open kind of DeFi lending. But on these, I see like Alameda and Block Tower and Maven 11, like some great players in the space who know a lot and are sort of able to utilize that capital really, really efficiently. And so if you're in the market and these players, you're like, okay, yeah, I'm willing to lend to Alameda because they're brilliant and they have this incredible track record. Everyone knows them and everyone knows they've got a strong balance sheet. But like, how does that scale to 1,000 pools? And are you envisioning other mechanisms of information that become available to the marketplace, just like risk and reputation in eBay in the classic example, or Amazon, third-party sellers, or whatever the right analogy is? How do you think about scaling that so that the average person or institution is sort of facing? Is that just time and reputation, or how do you think about that?
Yeah, I think scale comes from two areas. So it's going to be, first of all, the way that our protocol scales is that we would need to add more pool delegates, and pool delegates can then functionally add more pools. And you can think of each pool being able to pursue its own strategy, whether it be targeting a particular industry. So I'd say right now we have a fairly high representation of, crypto financial institutions, market makers, trading funds, arbitragers. But you could also see, an industry a pool that might be targeting the tech industry or SaaS companies.
Yeah.
Or you could see a regional focus there where it might be Southeast Asia or a European exposure or North American. And so that helps us scale the number of pools, and it helps us capture more kind of lender preferences where they might not want just a mono exposure or a largely diversified exposure to every company in the space, but they want to select a specific industry. And to that end, I think it's the information about the pool delegates underwriting. So it's like you might evaluate, Vanguard or any other kind of like fund manager in that respect, but you would want to see how well they've performed in terms of underwriting, defaults, NIM generated, that kind of thing. And so I think that's one element.
That data is effectively on chain, right?
It is.
Because all the funds flows are done on chain with stable coins, mostly, or whatever. And so you have all of that, right? You're not relying on third-party assurance, so to speak.
Yeah, exactly. And then on the flip side of that, then you have more kind of borrower-specific information. And borrowers really like the product because all of their loans and loan performance history are on chain. So they can transparently show, hey, we've repaid 5 loans with perfect payment history. And so over time, that helps them build a better credit worthiness profile, credit score, so to speak, and then they can borrow on better terms. And these are things that otherwise would have been totally private within the private placement market. Right. It never would have been legible.
Right. Yeah, so I mean, it's I like to use this analogy often of, I think in a conversation we were having the other day, I talked about like long tail markets. The internet's really great at creating long tail markets for content like YouTube, or long tail markets for advertising like Google, long tail markets for commerce like Amazon, blah, 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 right? So theoretically, right, you can create these long tail markets on these kinds of infrastructures, which is super, super exciting because it really is about democratization to access to capital on both sides, right? On both sides, the investor lender slash and then on the other side, the borrower. But all of these platforms have been able to use data and use data and effectively various forms of scoring or predictive analytics or other things. And do you envision that, like, you're going to have enough data that this effectively will provide that level of sort of signaling that it can be a mass scale infrastructure?
Yeah, I think so. And I mean, as we scale, so we're still very early on in terms of gathering those data points. But as you gather enough points on both good credits and bad credits, then naturally data scientists are going to be able to enter the ecosystem, look at this, and try and formulate credit scoring models. Yeah. And you could see the birth of effectively like on-chain ratings agencies.
Absolutely.
That would have this kind of technical expertise to scrape all this information and process it. And that naturally makes it much more scalable then, because all the data is on chain. So you don't have that bottleneck and that friction in producing that scoring.
Yeah. Yeah. What is the, maybe just for the viewers and listeners out there, just these markets today, the markets that are operating on Maple today, what are the typical borrowing rates, APYs? What's this kind of typical cycle of capital kind of thing?
Yeah, so the product that we have on the marketplace at the moment in these pools is fixed rate, fixed term loans. So it really resembles the kind of the term credit market. And that was a deliberate decision because we wanted to be able to provide certainty around capital budgeting for these companies. So the loans would typically be kind of average size might be 5 to 15 million at the moment. It's been getting larger as we've been going. And then typical tenor might be about 6 months. So 6 months, interest only. Borrowers are typically paying an APY of between sort of like 8.5% to 12.5% at the moment. And that obviously fluctuates with the market. And then we began with some level of collateralization, but given we were targeting the most creditworthy borrowers in the market, these have shifted to be more uncollateralized, and that reflects the nature of the business because you're lending to a market maker who's always got the capital on hand because it's just in exchanges. Right.
It's interesting. So I wanted to talk about the collateral piece of this as well. It's under collateralized for the most part, but there is some that's uncollateralized. And is the collateral, what are the forms of collateral that are in the protocol today?
Yeah, so the forms of collateral that we accept today are cryptocurrencies. So it's WBTC, which is an ERC20 form of Bitcoin, of course. And then we've also taken stable coins, and we've onboarded the ability to do things like Aave or Link, for example, as collateral. So, but it very much remains within cryptocurrency as collateral. Yeah. And that partly reflects the thinking that, like, yes, real world assets are a larger total addressable market, but that the need for them wasn't really burning. Like the people who could borrow on good terms already were. So you would have had to go out on the credit risk curve to support real world assets at present. So I think we'll get there eventually.
Yeah. And is the collateralization, is that a decision that the pool delegate is making? So
yes.
Yeah. So that kind of quote unquote underwriter is sort of making that determination on.
Yeah. So they bilaterally negotiate things like price and collateral level with the borrowing client as they due diligence them, and that was something that was a deliberate design decision. We wanted the pool delegate. We really see ourselves as infrastructure for people to run lending businesses, fixed income asset management, and OTC lending desks. And we trust that those pool delegates have the expertise. We, of course, due diligence them and their processes before they get whitelisted. But we wanted to have that diversity in the ecosystem.
Yeah. There's sort of a lot of markets that you can go after. And clearly getting anchored in, kind of, let's just call it crypto capital markets participants is there's a real need, the volumes are higher, et cetera. how self-service is the protocol today, versus kind of needing to kind of be whitelisted into being in different roles on it and things like that. And at what point do you envision it being more self-service, so that someone who's like, I really understand mobile app entrepreneurs in Nigeria, and I'm gonna be the I'm gonna write that risk, so to speak, or whatever it is, right?
So how soon before we have like Tala as a delegate on the protocol? I think so. Right now, early on, it's kind of it's in more of a curated stage, and that's because we wanted to ensure a good experience for lenders and also for the borrowers who come on board. So you have this kind of whitelisting process where we would go through, understand like the way that a delegate is going to underwrite and assess borrowers, and which target markets they go after, so it doesn't cannibalize existing pools. But as we scale up, we want that to be more self-service, where a pool delegate could say propose themselves, and then it could be approved by governance. And that's really like part of this pathway to like progressive decentralization of the protocol.
It's a good tie-in to the broader kind of Maple architecture, and I think the existing concepts of like there's a bank that facilitates all this, or there's an ATS that's like a specific market for a certain bucket of debt instrument trading, or OTC markets like that. And there's lots of analogs that are out there, but Maple is a DAO, and the Maple token and the protocol are governed. And that, it sounds like, as you're describing it, that governance is going to play a significant role in kind of determining how, what kinds of market participants get involved, how this grows, et cetera. Maybe you could just walk through the mechanisms that are there today. What is that today? And then, maybe walk me out 18 months from now, and what you're envisioning, what kind of coordination is happening, and what kind of decisions are being made, and how's that growing the market?
Yeah, it's an interesting question, because the level of decentralization of various DeFi protocols in the communities comes up all the time. And I think you've seen at the far end of one spectrum, you might have total on-chain governance at the moment, and that's really suitable where you might have a limited number of parameters that need to change, and otherwise the protocol is totally permissionless. But in the case of Maple, it's like there is a bit more complexity, because you're making decisions on, say, bringing in a trusted party, like the manager or the delegate running the pool. And so the level of decentralization that we've got in place at the moment is that there is a multi-sig controlling that DAO wallet, or the DAO wallet or address has the treasury funding, and then it also has the ability to change settings, be it fees, lockups, or pause the protocol for security reasons. So that's decentralized away from core team and involves members of our cap table. And then I think over time we will add community members to that multi-sig. But then the way that it makes decisions to reflect the will of the community is that we poll the community in voting proposals. And so we have Maple improvement proposals. So it would receive a write-up in the community forum. It would need to get endorsement, and then there's a 7-day voting period that's opened where people who hold a specified percentage of the token can vote. So it's kind of, it's a bit of a crude implementation at the moment, but as it increases in sophistication, you would see things like full implementation of Snapshot, where it's token weighted voting rather than just a person gets a vote when they satisfy a minimum level. And then as we progress, you'd start to see that proposals are actually queued in as upgrades to the code or actual changes to the settings, and those are just voted in where the voting actually triggers the implementation. So that's kind of the path to where you get to, I think, over 18 months. But I think it's actually really important that communities have, I don't think you can have a vote on everything. It's inefficient. It detracts from the idea of product vision and design decisions. So I think the way I would see it working is that, you know, effectively the community might elect multi-stakeholders who would kind of represent, you know, good governance, and then they would choose, you know, operational managers who then make the executive decisions day to day and staff out the team that you need to make the decisions that you just, you know, you don't want to be voting on all the time.
Yeah, and I mean, I can imagine, you know, down the road, right? You have like the example of leveraging DAO token holders for making decisions, like kind of market expansion decisions, which is really about who are you allowing in as pool delegates. And that you could have a tiered structure where you're kind of delegating down to, you know, there's a group that's like very, very focused on, you know, I'll use that example, fintech in Africa or whatever. And then you're basically delegating down to that group to basically, you know, be in the market finding the pool delegates for, you know, for a whole set of investing activities or borrowing, etc. And that. So you kind of have the market expansion, you know, the community could actually drive the market expansion of this in some pretty significant ways as well.
Yeah, 100%. And I think it's kind of interesting at the moment because, like, if you look at a DAO, you know, a DAO doesn't have like a kind of legal entity behind it at present. Like, I know some jurisdictions are working to set that up, which could be an innovation that makes it easier for DAOs to do business with different vendors or service providers like lawyers, accountants, what have you. But it is also this interesting time where when you talk to people who are service providers and you explain that you're a DAO, it's kind of like there aren't the mental models on the other side to actually sort of conceive of what's happening. So that often puts a bit of a stopper on business. But it's kind of the same way, you know, 500 or 700 years ago, someone might have asked you like what religion you belong to or dominant kind of, you know, theism, rather than there wasn't the concept of a nation state, whereas now everything needs to be tied to a nation state jurisdiction. And maybe in future that shifts a bit. Yeah,
I mean, the invention of the joint stock corporation was about 500 years ago as well. Took a while for it to kind of take hold. But I talk a lot about you know, and other people too. But basically, like we're finally we're reinventing corporate forms, and we're going to graduate past the joint stock corporation. I think pretty readily, and I think, you know, it's just reflective of how you know, capital and work can be organized in the age of the internet, and what that looks like. So to me, this is just you know, I think the birth of a new era and how labor and capital is organized. But it's interesting. It's sort of I'm very excited about where you can go with this, obviously. But you know, maybe kind of coming back in a little bit to that for you, you know, does this eventually compete with or provide the infrastructure to enable firms to compete with commercial banks at scale?
Yes. So the way I see us is that Maple's not a lending company competing with commercial banks or the likes of JP Morgan. Instead, we're more like a layer of infrastructure. Kind of imagine it being like Shopify. Shopify created this new platform. Anyone who wanted to compete in e-commerce could set up a virtual shop front. They compete on price, range, selection, what have you. We're doing the same thing for capital markets. So you could have a team, you could have a commercial bank, you know, set up and run a pool on here. You could have a team break away from a commercial bank and set up and run a team. But then they're competing on ability to manage risk, ability to source capital.
It's like credit funds compete with commercial banks.
Exactly.
On a huge scale now, right? I mean, that developed over the past, whatever it is, 20, 30 years, right? Yeah.
But one of the difficulties for them is that they still have huge fixed costs. And what Maple does is kind of like, I guess to borrow another analogy, it sort of compresses that in the same way that Amazon did for spinning up servers and infrastructure. And it converts this to a variable cost proposition. Now that makes it much easier now to be a team of 5 or 10 running a lending business or a credit fund and competing with really large banks, because you're on a level playing field of infrastructure. And that actually, I think it makes the market healthier, because it gets away from the idea of returns to scale, and it brings us back to a more level playing field, and kind of, I guess at best, can kind of unbundle some of those structuring teams. Like really promising ones can go and run their own business on top of Maple.
Yeah, totally. One of the things that using that long tail markets concept a little bit more, that the internet's really, really good at bringing experts together. Reddit communities are sort of like one example, but there's obviously huge numbers of kind of expert-led communities. Obviously, just the ability for people with knowledge to kind of synthesize that, organize that, interact around that, empowers decision making and understanding, far more sort of decentralized and far more open kind of models. And when I think about long tail capital markets, it seems like kind of taking a little bit of that and finding ways to structure that in tooling that supports these, call them pool delegate formation or whatever on Maple terminology. It's potentially really, really powerful, right? It may be that the people who can actually like figure out at a very micro level, like what's a good opportunity from a lending perspective, may not be people who have any background in finance at all. It may actually just be people who are really close to a geography, a domain, a community, and can kind of convene that knowledge. And it's, I think, to the degree that DAO members, as it were, can extend to normal people, not FINRA licensed, the other, right? But sort of an internet of kind of participation. It's really interesting. Obviously, we're not there right now, but you can imagine that.
We'll get there over time. And I like that idea of the long tail, because, I mean, one thing Tim Ferriss has talked about before is like the idea of finding 100 true fans to kind of run like an internet business. Now, as a lending company, like let's say you're part of JP Morgan or Fortress Group or something. Now, maybe you can't find 100 SaaS companies within a specific niche in, like North America. And so that then means you can't find a market. But across the breadth of the internet, you might be able to find 100 of these SaaS companies. Yeah. That's enough to set up and run a pool around if you have the expertise there. Yeah. And that's how we can serve the kind of the long tail of these companies that are kind of, building out the future there. Yeah. And you can run a durable business.
Yeah, I mean, theoretically, right? I mean, someone who's organizing $5,000 loans and doing that, a whole bunch of those, I mean, the unit economics will work, right? And it doesn't have to be, that's the scalability model. And I use with long tail markets in other areas, like I can be like I make, I don't know, 50 grandfather clocks a year, and I sell them on Amazon. Yeah. I sell them on Amazon because people, and you go to my website, you learn about them, you click through to Amazon, and Amazon gives me my logistics, but I only sell 50 of these things. And it's my passion, and it's what I do. And you know what? I can go to Google and I can actually, buy ads that, target, income holders in these cities with this, of people who are likely to want to buy original grandfather clocks or whatever. And I can find that person and I can efficiently reach them because I have self-service tools and the ability to kind of match that. And so it's that sort of level of what's happened in commerce. It's just like bringing that to capital, basically.
Yeah. I mean, the core things that infrastructure like this help with are kind of that discovery function. I mean, as you said, like if you're making those grandfather clocks, but you can use targeted ads to acquire customers,
right?
You know, massively lower customer acquisition costs, and it's the same for someone running one of these.
You could businesses. Have a pool delegate that just goes out on Amazon or goes out on the Sidneys. I'm going to find ways to, you know, lend to product categories that I think could expand because I think that they have a great product and I want to get behind them. And so, there's so many ways that can be brought together.
Yeah, 100%. And we've also seen interest from the kind of the fintech lenders in other regions who have expertise. So they might actually see us as a wholesale capital market where they could borrow, you know, like $50 or $100 million and then start parceling that out in smaller loans. Yeah. And that would be akin to what I used to be doing in institutional banking, finding those players.
Totally. Yeah. So it works in that way as well. You know, one of the things that we've been thinking a lot about is, you know, in DeFi, in basically, you know, in on-chain finance, let's just call it, whether it's a peer-to-peer payment or participating in a market, or even just like showing up with my wallet to a game and wanting to get some virtual goods or whatever, like all these things on Web3, you know, but very much when you get into capital markets, right? You know, there's this huge issue of identity and, you know, how to create a way for, you know, entities, whether they're individuals, households, firms, whatever, for entities to kind of prove themselves and then have protocols be accepting of those kind of proofs. You know, how do you think about identity and kind of credentials tied to identities being critical to how a protocol and an infrastructure, even the DAO itself, can scale?
I think it would be a massive unblocker to scaling, and there's a couple of reasons for that. So the largest institutions won't participate in DeFi over, you know, concerns about compliance, AML, KYC, that kind of thing. So the ability for identity to be managed in a productized way, because currently it's done manually by almost every participant in the space. So the ability to productize that then means that it can be built into user flows, just like a login or authentication. And for DeFi to really grow its volume significantly, I think you need to see more institutional participation, and that will come as you know, if you can solve this idea of identity and KYC and compliant usage or participation in these protocols. We launched our two most recent pools were permissioned, and that was a very deliberate decision so that we could access more participation from larger institutions, which we see as really core to driving growth on the platform. But we have to KYC all of them. Yeah. And so
if some wallet showed up and you're like, oh, okay, whatever, Circle or Coinbase or FTX or whoever has basically done the identity, you know, checks on this and is a known institution or whatever it is, like your protocol could say, okay, I'm comfortable with, you know, entities that have that, and maybe there's a way if there's a compliance reason to do a you know, information exchange or whatever or something.
Yeah, 100%. And if you can, so like the idea of having, you know, like identity that sits at the wallet level and you know that it's been done by somebody, you know, done by a verified issuer, it just significantly eases the friction of onboarding. And that's when it starts to, DeFi starts to become just like a much better user experience, which is something that everybody always cites as like the reason that DeFi is not taking off.
Yeah, and not only is it a better user experience, it's actually it can still preserve security and privacy in ways that are even better than how the existing financial system works. Yeah. But yeah, I mean, it unlocks comfort at an institutional level and then ultimately down to the individual level of comfort to use this infrastructure. And yeah, I think, well, we all will stay tuned for improvements that happen around that. Yeah. It's really exciting. I'd love to hear, you just talk for a minute about, and obviously you don't need to share anything confidential or proprietary, but just, a little bit of, from where you started, having conversations with different types of entities that might be using that to kind of where you are today, in, just over a year, I guess, year and a half now, or no, less, way less.
Less, yeah. It's like 8 months of being live.
Okay, yeah. So over 8 months, you kind of, I'm sure you've seen the kind of conversations evolve, but like, what's the difference from then to now, and what does that tell you?
Yeah, so I think we launched on Mainnet back in May of 2021, and that was with a very first single pool of 17 million in loans. And then since then, we've now scaled that up to the point where we're currently sitting on about 505 million in TVL, so just over $500 million. And that was achieved in about 7.5 months of growth. And we've now spread out to having 4 pools. But I would say the change that has occurred in the conversations is, one, the Lindy effect. So seeing is believing. It was a lot harder to even get a foot in the door with these conversations before we were live. Then you go live and it's like, okay, this is just an experiment. Then you hit like 100 million. It's like, okay, this is maybe a thing. And now we can sort of comfortably have a lot of conversations with various TradFi institutions who are now actually looking across at this going, okay, like we're actually quite serious about participating on this, whether as a lender or maybe spinning up a pool as a pool delegate. So I would say there's a number of CeFi and TradFi players who've expressed interest in this, and they're actually looking at it, with the lens that we try and push, which is it's infrastructure. This is just a new platform and way of running the businesses that they've previously been familiar with, lending businesses. It's just when you're dealing with a B2B product like this, the sales cycle is a lot longer in terms of getting them comfortable. And so you've got to have multiple conversations with kind of compliance teams and risk and satisfy them on that. But the Overton window has shifted incredibly from, early 2019, DeFi wasn't a thing. Then early 2020, under collateralized lending wasn't a thing. And, it's amazing to see, I think in the under collateralized lending space has now been over $1 billion of loans done. And I think probably over this coming 12 months, I would expect that to at least 10x.
Yeah, absolutely. Yeah. I mean, I often talk about the market opportunity for crypto finance. There are many market opportunities in crypto finance, but when I think about, stable coins and lending and what that can look like, I mean, M2 is a big number. M2 is like $115 trillion. And if you break down M2 in terms of what that is and how much is uncollateralized, and is, credit expansion for people who are building businesses and, so on, it's staggering. It's staggering. Right. And we know how bad the existing, system is in terms of efficiency and effectiveness. And so it's cool. It's going to be very, very exciting to see.
On that note, like I think, with tools like USDC, right, and the ability to connect USDC with a capital market, you lower the barrier to entry to being a participant in capital markets and being a net saver or a net borrower. So you could be a net borrower if you want to expand your business. Maybe if you had a bumper month or bumper year, you've got surplus capital, you want to invest it and deploy it in a capital market. Well, when you make it much, much easier to access that and in smaller amounts, you dramatically expand the pie, right? It's like the idea of the Sony Walkman. It was like, as soon as it became popular, it was like 10x the number of people who could listen to music and consume it, right?
Yeah. So I talk to monetary theorists and central bankers and other folks from time to time. And, one of the things that I talk about is, the possibility that you could have a full reserve, digital currency, like USDC kind of thing, but still have money multiplication and money velocity that meet the credit expansion needs that are there. And one of the things that's really unique about stablecoins, blockchains is, we're now seeing that, from a capital efficiency perspective, you actually can, store and transmit value basically to anywhere in the world at a fraction of a cent, with finality and security. And, fractional reserve banking in some ways reflects the capital inefficiency of the way money actually moves in the world. And if you collapse that, the physics of money change. And if you you have a full reserve instrument and the physics of money become, you could theoretically, to your point of net borrow versus invest, right? You could have, an individual or a household or a firm that's, let's say it's, I got 5,000 sitting there like a demand deposit account, or I've got, $1 million sitting there like a corporate cash account. And it could be, very, very efficiently on a programmatic basis being utilized as a facility without having to create new money with a locking mechanism. So you actually theoretically can build, I think, mechanisms that provide the superior capital availability to net borrowers without introducing the fundamental risk of fractional reserve. And so it's maybe a theoretical question right now, but I think the kinds of infrastructure that you're building and stuff that we're interested in, paints a picture of maybe a slightly different model for how how this can work for society.
Yeah, I think so. And I'm interested in, like, in terms of network science, like the emergent properties that'll come out of an international financial system that's now more connected across the globe.
Exactly.
Where, like, the ability to transfer money in 15 seconds to the other side of the world versus T plus 3 days is like, what's going to come out of that?
Solana, you've got 400 milliseconds and a fraction of a second.
100%, which is something we're pretty excited about. So we're going to start to build on Solana and launch a V1 of our protocol there as well. But hugely exciting.
Yeah, absolutely. So this has been a really enjoyable conversation. Congrats on the momentum you guys have, and we're excited to be a partner and working with you and building with you. And really excited to see what happens over the next year. And I'm sure we'll have you back here on the show as well.
Yeah, thanks for having me on, Jeremy. Love to come back. Really enjoyed it.
Cool. Thanks, Sid.